The kings of big tech just reported their earnings, and instead of celebrating, Nvidia's stock took a hit, and that should tell us something important about where the AI revolution is actually heading. Welcome back. Let's dig into what's really going on beneath the surface of these numbers, because this story is far more layered than a simple stock dip. Nvidia has been the undisputed crown jewel of the artificial intelligence boom. Its H100 and now Blackwell chips have been the engine powering everything from ChatGPT to Google's Gemini, from Microsoft's Copilot to Meta's Llama models. For the better part of 2 years, demand for Nvidia's graphics processing units was so astronomical that companies were essentially begging to get their hands on them. Waiting lists stretched for months. The stock surged over 200% in a single year. Jensen Huang became something of a Silicon Valley rock star. Everything looked bulletproof. So what changed? Well, when the biggest players in big tech, Microsoft, Meta, Alphabet, and Amazon, report their quarterly earnings, the market doesn't just read the revenue figures. It reads the tea leaves. It listens for signals about where capital expenditure is going, how aggressively these companies plan to build out their data center infrastructure, and critically, whether they're becoming more selective about which chips they're actually buying. And here's where it gets genuinely interesting. Several of these tech giants have been quietly but aggressively developing their own custom silicon. Google has its TPU's tensor processing units. Amazon has its Trainium and Inferentia chips. Microsoft has been deepening its partnership with AMD while simultaneously investing in its own chip design capabilities. Meta is building its own AI accelerators as well. These aren't side projects anymore. These are serious, strategic bets designed to reduce dependence on Nvidia and, frankly, reduce the enormous cost of running AI at scale. Now, none of this means Nvidia is suddenly in trouble. Let's be very clear about that. The company's revenue numbers remain staggering, and the Blackwell architecture represents a generational leap in computing power. Enterprise demand for AI infrastructure isn't slowing down in any meaningful way. But what the market is recalibrating is the pace and the exclusivity of Nvidia's dominance. When Microsoft or Alphabet signals even a marginal shift in their chip procurement strategy, even a slight plateau in Nvidia-specific spending, investors react because at Nvidia's valuation, perfection has essentially been priced in. Any deviation from that perfection, any suggestion that the moat might be narrowing, triggers a sell-off. That's the dangerous arithmetic of being the most valuable chip company on the planet. There's also a broader macro signal here. Big tech earnings, while largely strong, revealed something nuanced. The monetization of AI is proving harder and slower than the infrastructure build-out that preceded it. Companies have spent billions laying the foundation, but the revenue returns from AI-powered products are still maturing. That gap, between investment and return, is starting to make some investors nervous about whether the AI trade has gotten ahead of itself. And that nervousness has a name, and right now that name shows up in Nvidia's stock price. AMD continues to gain traction as a credible alternative. Startups like Grok and Cerebras are carving out specialized niches. The competitive landscape that once looked like Nvidia standing alone on a mountaintop is starting to look more like a crowded race with multiple serious contenders finding their footing. The AI chip race isn't slowing down. If anything, it's accelerating. But acceleration in a race means more competitors, more strategy, and more uncertainty about who crosses the finish line first. The real question isn't whether AI will transform the global economy. It's whether one company can hold the keys to that transformation forever or whether the kingdom is finally starting to divide.